The most dangerous moment in your financial life is not when you are poor. It is when your ship gets bigger and you start believing size itself means safety. That is how people drown with money. They do not sink because they never earned enough. They sink because as the hull grows, the leaks become more expensive, the blind spots become wider, the ego becomes louder, and the water pressure from one stupid mistake becomes strong enough to crack the whole vessel. Most people think wealth protects them automatically. I think wealth amplifies whatever was already weak in the hull. If you were sloppy before, you become sloppier with nicer furniture. If you were ego-driven before, you become grander with your mistakes. If you were undisciplined before, you become more elegantly undisciplined. If you were structurally sound before, then yes, wealth helps. But if you were leaky before, money does not save you. It just gives the ocean more surface area to hit. That is the first truth. A bigger ship does not forgive bad design. It punishes it. I have watched people move from scarcity into real money and somehow become less safe, not more. Their accounts grew, their assets multiplied, their options should have expanded. Instead, the ship got heavier, less maneuverable, harder to understand, and more exposed to one violent wave. On paper, they looked wealthier. In reality, they had become easier to sink. That is why I want to talk to you like a shipbuilder, not like a motivational speaker. The game is not merely to make the vessel bigger. The game is to protect the hull, because the ocean does not care whether your net worth sounds impressive at dinner. The ocean cares where the pressure points are, and the pressure points of wealth are almost never where beginners think they are. Poor people worry they do not have enough sail. Richer people often discover the real danger was a crack below the waterline that nobody felt like checking because the deck looked beautiful in the sun. That is how overconcentration ruins people one hole. That is all it takes. You can have a fine ship, a good captain, decent weather, years of progress, and then one ugly hole changes the whole fate of the trip. A single stock becomes too large, a single business becomes too central, a single property becomes too symbolic, a single income source becomes too dominant, a single macro thesis becomes too emotionally important, and the person tells himself it is confidence. Number, it is single hole risk. If one position grows to 10%, 15%, 20%, 30% of the whole vessel, you are not being bold. You are giving one patch of metal the power to decide whether the ship survives. That is not wealth building. That is emotional dependency dressed up as conviction. I have nothing against conviction. I have a lot against concentrated fragility. The trap is psychological before it is mathematical. People start loving the position because it made them feel smart. It rises. It flatters them. They begin treating the asset like a mirror instead of a tool. They no longer ask, is this still rational? They ask, what would it mean about me if I reduced it? That is when the asset has stopped being part of the ship and started becoming part of the captain's identity. That is dangerous. I have seen investors spend years attached to one shiny name while the broader market kept sailing. A darling from one era can spend decades below its old peak while the ocean moves on without it. But the emotionally attached owner does not move on. He waits for vindication because reducing the position would feel like admitting he mistook luck for genius. That is not discipline. That is sentimental shipwreck. A rational owner wants no single plank to decide the fate of the whole hull. Most mature portfolio builders understand this. One holding should rarely become a dominating percentage of the total structure. That is not because the asset is bad. It is because the sea is indifferent to your favorite story. Stable, durable compounding comes from hull integrity, not from romantic attachment to one shiny piece of metal. Then comes the second leak. Luxury ballast. This one kills more people than bad investments do. A ship is supposed to carry cargo. The trouble starts when the captain becomes addicted to decorative weight, better cabin, better tableware, more polished brass, bigger dining room, extra levels, more status features. None of them help the ship survive a storm. All of them make the owner feel important in calm weather. That is what lifestyle inflation is. Luxury ballast income rises, and the ship gets heavier before it gets stronger. A person earns more and immediately starts buying a more expensive identity. Nicer house, better car, better watch, better school district, better vacations, more private comforts, more public signals. Every upgrade feels earned. And that is precisely why it becomes lethal. The person is not buying practical utility anymore. He is buying weight that has to be carried every month. The culture calls this success. I call it voluntary drag. The ugly proof is everywhere. People earning enormous salaries still live paycheck to paycheck because the ship grew in all the wrong directions. A person making less than $50,000 and living close to the edge is easy to understand. But when someone making $300,000 or $500,000 still has no real margin, the issue is not income. The issue is ballast. The structure absorbed every gain into a more fragile lifestyle. That is what most people miss. Richer does not automatically mean safer. Sometimes richer just means heavier, and a heavy ship with no discipline is a storm's favorite meal. The wealthy people I have most admired were not the ones who looked richest after a raise. They were the ones who kept the old appetite while building a new balance sheet. The millionaire next door got famous for a reason. Quiet vessels survive. Simple vessels maneuver. Ships with modest visible lifestyle and powerful invisible reserves rarely get applause at the marina. But they are the ones that keep moving when rough weather hits. Real satisfaction does not come from building a floating showroom. It comes from knowing the vessel will still be there when the wind turns ugly. The third leak is one most people refuse to talk about because it sounds boring. Tax leak. People obsess over restaurants, subscriptions, coffee. Little luxuries and visible spending, while the largest recurring hole in the hull is quietly draining them every year with full legal permission. Taxes are often the largest single expense in an adult financial life, yet huge numbers of otherwise intelligent people manage them like children. They buy the right assets in the wrong compartments. They sell without understanding the tax wake behind the decision. They ignore harvesting losses when losses could have reduced future tax damage. They collect dividends in places where every distribution gets taxed unnecessarily. They treat their 401k, ERA, Roth, HSA, and taxable accounts as random containers instead of a strategic fleet map. That is expensive laziness. Let me make it plain. If you put high dividend holdings in taxable accounts while tax-sheltered space goes underused, you are not being simple. You are paying the sea to come in faster if you trade short. Term, when holding longer, would qualify for more favorable capital gains treatment. You are not being active. You are donating part of the ship because impatience made you feel busy. If you ignore tax loss harvesting entirely, you are refusing one of the few legal pumps available to throw water back overboard. I do not worship taxes. I respect their bite. And adults with growing net worth must respect them even more because a tax leak scales beautifully against the lazy. The bigger the ship, the more the whole matters. The larger the income, the more expensive indifference becomes. That is why real wealth building is never only about returns. It is about after-tax returns. What stays in the ship matters more than what looked good on the chart. The fourth leak is rust. Not dramatic enough to make headlines. Just steady decay because the owner could not be bothered to do the math. Refinancing laziness is rust. If your mortgage or major debt sits at a high rate and the rate environment shifts meaningfully lower, refusing to examine a refinance is not stoicism, it is neglect. A 1-point drop on a large mortgage can change the pressure on the hull every single month. Yes, the refinance itself has a cost. Of course it does. Nothing structural comes free. But if you plan to stay long enough, the right rate change can take a grinder to recurring drag. That matters. If a loan balance is large and the rate can fall meaningfully, you do not ignore that because paperwork is annoying. You run the numbers, you compute the break-even. You compare the months required to recoup the closing costs against how long you truly expect to keep the debt. This is not sexy. Again, good. Most of wealth is hidden in the unglamorous discipline of respecting recurring pressure. Small monthly relief repeated for years becomes a structural edge. And structural edges are what keep ships from aging badly. Now let us move to a more subtle danger: time theft. This is where people with rising net worth often commit a beautiful kind of stupidity. They get richer, their capital starts producing real returns, and yet they continue acting as if every extra hour of labor is the highest value thing they can offer the world. They overwork. They let the vessel grow but never adjust how they value their own time relative to what the vessel is already producing. That is a trap. Suppose your portfolio is around $5 million and earns a modest 5%. That is roughly $250,000 a year, roughly $680 a day. Think about what that implies. Your capital may already be generating more daily value than many forms of extra-human grind, and yet the workaholic keeps behaving as if one more meeting, one more hour, one more email, one more small incremental push must always be superior to reclaiming life, health, relationships, or strategic thinking. This is not about becoming lazy. It is about understanding when the ship is already generating forward motion without every ounce of your muscle chained to the wheel. The saddest wealthy people I have seen are often not broke. They are overcrewed on their own vessel. still running around tightening ropes that no longer require their hands, still proving something to ghosts, still sacrificing the only truly non-renewable asset, time, even after the ship itself could now do part of the work. Do not misunderstand me. Striving matters, purpose matters, work can be dignified and meaningful. But when the vessel begins to generate enough forward force, you must periodically ask whether your labor is still strategic or has simply become addiction with a necktie, because there is one regret that shows up over and over near the end of life. People rarely wish they had answered more emails. They wish they had lived more while the vessel was strong enough to carry them. The fifth leak is one of the cruelest because it rides in on success. Victory fever. A few good years can turn a disciplined captain into an idiot. A person picks 10 good stocks during a bull run. Most rise, he becomes convinced the gains prove not only intelligence, but superiority. Then 10 stocks become 5. 5 become options, margin appears, earnings, day gambles appear, concentration deepens. The ship narrows, the ego grows. And when the weather changes, the same person who thought he had become the greatest investor in history discovers that 2 good years were not expertise. They were a rising tide with a flattering reflection. I have watched this so many times that I no longer find it interesting. Early success is often not the test people think it is. It is a sedative. It numbs respect for risk. And once respect for risk goes, the hull begins to thin. Day trading is one of the loudest forms of this disease. People see motion and mistake it for mastery. They see a few wins and mistake them for durable edge. They have no coherent structure, no real respect for base rates, no understanding that up to 90% of day traders ultimately lose money. And yet they continue, because adrenaline is addictive and the scoreboard updates fast enough to simulate importance. But the ship does not care how exciting the wheel felt. The ship cares whether it stayed afloat. That is why I distrust any form of investing that makes a person emotionally louder as it continues. The right kind of wealth building usually makes you calmer. The wrong kind makes you theatrical. And theatrical captains sink interestingly. The sixth leak is dashboard fog. Over complexity as net worth rises, people often begin collecting financial fragments like magpies, brokerage here, another brokerage there, 4 bank accounts for no reason, private deals with old friends, angel investments they barely understand, a bit of real estate syndication, some crypto left in an old wallet, employer equity, retirement accounts in multiple places, a partnership with weak paperwork, a taxable account nobody consolidated, a private credit note they forgot to reevaluate. The vessel keeps gaining compartments until no one truly sees the whole map. That is dashboard fog. And dashboard fog is dangerous because complexity flatters ego while hiding risk. Many high earners are comfortable making 6-figure decisions while only pretending they understand the underlying structure. They are not stupid, they are scattered. But scattered wealth is often fragile wealth because asset structure, fee drag, account placement, correlated exposure, tax treatment, and hidden risks all begin to matter more as the ship gets larger. A small fishing boat can survive with a messy dashboard. A larger ship needs instrumentation. You do not get to scale complexity indefinitely without paying for it in blind spots. This is why, at a certain level, simplification is not a convenience. It is a form of survival. Consolidate where possible, know what you own, know where it is, know what it costs, know how it is taxed, know what is liquid, what is locked, what is correlated, what is pure vanity, what is actually performing, and what is merely clutter that made you feel diversified while quietly increasing administrative chaos. Professional advice can help at this stage, not because advisors are magicians, but because outside eyes sometimes see fog more clearly than the captain who has been sleeping inside it for years. The point is not dependence. The point is visibility. The 7th leak is the one I have warned about repeatedly in other contexts because it never stops mattering. Liquidity starvation, too many assets, too little cash. This one humiliates people with fine-looking statements because on paper they appear wealthy. In real life, they cannot move. Their wealth sits in retirement accounts, home equity, private vehicles, partnerships, hard assets, illiquid businesses, and things that may be valuable but cannot become spendable or actionable within 7 days without pain. That is not strength. That is a ship with cargo and no lifeboats. I want you to understand this properly. Liquidity is not for timid people. Liquidity is not only an emergency blanket. Liquidity is maneuvering power. If an opportunity appears and you need cash now, not after a committee meeting with your own balance sheet, then illiquid wealth becomes a spectator sport. If a seller is desperate and you are asset, rich but cash, poor, you are not a buyer, you are an admirer. If life hits and you must sell productive assets under pressure because you kept no liquid buffer, you are not unlucky, you are underarmed. 3 to 6 months of living expenses is the toddler version of liquidity. Useful. Yes, sufficient for a growing ship with a high-income captain, low expenses. And larger opportunities around him, often not, as net worth rises. More liquid cash or cash equivalents frequently become more useful, not less, because the decisions become larger and the opportunities more interesting. The source transcript is exactly right on this point. Wealth between 1 and 2 million can still be astonishingly illiquid. Families look rich but are trapped in housing and retirement accounts. They have hull size without maneuvering fuel. That is why I respect cash. Not because it is glamorous, because it lets you turn. The 8th leak is delay tax retirement procrastination. People think the dominant variable in retirement wealth is how much they earn. It matters. But time still matters, more than pride wants to admit. Start saving at 25, and the machine has years to work. Start at 35, and the same annual contribution can finish at roughly half the result. That is not a motivational slogan. That is the cruelty and beauty of compounding. This is one of the reasons I keep telling adults to capture at least half of each pay raise and send it to future structure before lifestyle notices. If every raise gets absorbed into luxury ballast, then the ship gets prettier while the retirement engine remains small. If at least half the raise goes directly to future ownership, the hull strengthens every time the income wind improves. That one rule is simple enough to survive real life. Half the raise to the future. Every time do that repeatedly, and the ship changes, ignore it, and the ship becomes one of those polished vessels that photographs well and sinks expensively. The 9th leak is no shield, insurance neglect. This one is deeply unromantic, which is why people ignore it. As net worth grows, so does the value of what can be damaged, stolen, sued, or lost. The home appreciates. The valuables rise. The family becomes more dependent on your earning power or your structure. Yet people often let old insurance levels sit there like forgotten sandbags. Coverage lags the true value of what the vessel is now carrying. That is foolish. You do not own a growing ship, and then insure it like the smaller version you sailed years ago. Regularly verifying declared values, liability exposure, replacement costs, and family protection is not paranoia, it is maintenance. The world contains storms, thieves, accidents, lawsuits, and mechanical failures. Insurance does not make you strong, it prevents one stupid blow from becoming a hole too large for the pumps. And that is really what this whole conversation is about, pumps. People imagine wealth as a smooth upward line. It is not. It is ongoing defense against water. Overconcentration drills a hole. Lifestyle inflation adds ballast. Tax inefficiency lets water in through hidden seams. Refinancing laziness lets rust spread. Overwork steals the captain's judgment. Victory fever makes him arrogant. Complexity fogs the dashboard. Illiquidity leaves him unable to turn. Retirement delay weakens the long voyage. Poor insurance leaves the hull exposed. You do not need all 10 of these traps to sink. 1 or 2 can do the job if ignored long enough. That is why I distrust people who talk about getting rich as if the entire task were upside selection. Wealth is partly about upside, of course, but as your net worth grows, a shocking amount of the game becomes about hull integrity. Can the vessel survive itself? Can it survive your ego? Can it survive complexity? Can it survive good years? Can it survive boredom? Can it survive ordinary life events without selling itself in pieces? That is the real test. Most people think more wealth means fewer decisions. In truth, it often means subtler decisions. The beginner's mistakes are obvious. Spend too much, save too little, borrow badly, fine. But the richer person faces a more interesting set of errors. When does concentration become worship? When does comfort become ballast? When does complexity become camouflage? When does confidence become fever? When does hard work become time theft? When does being invested become being trapped? When does being diversified become being disorganized? When does I'll do it later quietly become an unrecoverable decade? This is why bigger ships need better captains, not just bigger engines. And I want to tell you the rule that sits underneath all the others as your net worth grows. Every financial decision should be filtered through one question. Does this strengthen hull integrity or weaken it? If a new purchase raises recurring obligations and buys status more than freedom, it weakens the hull. If a tax decision preserves more after-tax compounding, it strengthens the hull. If a refinance meaningfully reduces long-term pressure after costs, it strengthens the hull. If a concentrated bet flatters your ego but magnifies single-hole risk, it weakens the hull. If a new account, investment, or deal adds dashboard fog without adding enough return to justify complexity, it weakens the hull. If more cash improves your ability to move, endure, or buy, it strengthens the hull. If more work steals time after the vessel already produces enough, it may weaken the hull of your life even while boosting your income statement. That is what mature money thinking looks like, not maximum excitement, maximum integrity. And yes, there is one more psychological trap I want to drag into daylight. As net worth rises, people often become afraid of looking too conservative or not sophisticated enough. They think simplification, more liquidity, lower concentration, tax discipline, and insurance maintenance somehow make them look ordinary. So they chase private deals, complexity, leverage, aggressive speculation, and stylish risk because those things sound richer, but sounding richer and being safer are two different games. I have never cared what looked clever at a cocktail party. I care what still floats. There is a deep dignity in running a strong ship, knowing what you own, knowing what it costs, knowing what can go wrong, having enough liquidity to move, enough humility to diversify, enough discipline to resist ballast, enough practicality to care about taxes and insurance, enough self-control to stop turning good years into ego fever, enough wisdom to let the ship serve life instead of forcing life to endlessly serve the ship. That is real wealth, not the number, the posture, the calm, the maneuverability, the ability to survive ugly water without becoming a forced seller, a frantic worker, or a delusional captain. So here is the choice I want to leave you with. As your ship gets larger, you can do what most people do: celebrate size, add ballast, ignore rust, worship one shiny plank. Let the dashboard get crowded, underestimate liquidity. Delay the long voyage plan, assume calm seas will continue. Confuse paper wealth with seaworthiness, or you can do the harder adult thing: run inspections, patch the hidden holes, pump out the tax leak, cut the decorative weight, keep enough cash to turn. Simplify the instrument panel, lower concentration before concentration becomes worship. Review the shield around family and assets, protect your time once capital starts producing, keep building retirement power while the years still listen. The first path flatters your ego, the second path protects your ship, and the sea has never cared about ego, only integrity. That is why so many people with money still sink, and why a few keep sailing decade after decade, while everybody else keeps asking how they stayed so calm in weather that destroyed more impressive vessels. They were not luckier, they just respected the hull,